Before any indicator, any chart pattern, any strategy at all, you need a clear picture of what a market actually is. This is Chapter 1 of the Foundations module, and in the next few minutes you will know what really sets a price and who is pushing it around. So let us start with the machine underneath. Every market you will ever look at is a continuous auction, running all day, in public. What that auction actually looks like is an order book. It has two sides. Buyers on one side posting bids, sellers on the other posting asks. At the very top of the buy side is the best bid, the most anyone is currently willing to pay. Below it sits a second bid, a little cheaper. And below that a third, cheaper again. Facing them is the best ask, the least any seller will currently take. Above it, a second ask wanting more. And a third above that. The price right now is simply where those two sides meet, where supply meets demand. And none of it stands still. Bids and asks change every second, so the price ticks along with them. Now here is the part that saves you years. This is the same auction on any instrument. A stock is one company. An index is a basket of companies. A crypto token is a digital asset. The same mechanism sets the price of all three. Indicators and patterns come later. Underneath all of it, a market is just buyers and sellers agreeing on a number, which raises the obvious question. What is that number actually telling you? A share is a slice of ownership in a company, but a trader is not really trading the business. They are trading the price, the number that moves every second while the auction runs. So what actually sets that number? Look at the two people behind it. This is price discovery, and it produces one print, right now. The highest bid meets the lowest offer, and they cross. On one side, the buyer, willing to pay, bidding up, and that is demand. On the other, the seller, willing to sell, offering down, and that is supply. The two of them move toward each other until the gap closes. And where they touch, the trade happens. That is the agreed price. Both sides said yes at the same number. No agreement, no trade, and no price. Which leads to the core idea, and it is worth sitting with. A price is not a company's true value. The buyer sets the ceiling, the most anyone will pay. The seller sets the floor, the least anyone will take. The cross between them is the price. Value is an opinion. Price is the number both sides said yes to. So if a price is only an agreement, what decides which side wins? The side that wins has a name. Two names, in fact, and they are the oldest words in the market. Every price move is a tug of war between them. Two animals, pulling in opposite directions. This is market control, and it is settled again on every single price move. The bull charges upward, horns lifting. The bear swipes downward, claws coming down. They are set against each other, always. One pushes up, the other pushes down. When the bulls have it, buyers are in control, demand beats supply, and prices rise in a staircase of higher highs and higher lows. When the bears have it, sellers are in control, supply beats demand, and prices fall in the mirror image, lower highs and lower lows. Neither side is permanent. The same instrument is ruled by bulls for one stretch and by bears for the next. Buyers push prices up, sellers push them down, and the winning side sets the trend. But where exactly does one side run out of strength? Price does not turn at random. It turns in the same places again and again. Put it on a chart, and those places jump straight out. This is price action, and these are reversal zones. Watch the candles run up, stall, roll over, then find a floor and bounce. The ceiling up there is the supply zone, where sellers overwhelm buyers and price falls away. The floor down there is the demand zone, where buyers overwhelm sellers and price bounces. Notice that each one is an area, not an exact price. It works largely because the participants remember it. It held there before, so they act there again. Traders watch for price to turn near demand and to stall near supply until a zone breaks and a new trend begins. And that shared memory is the clue to something much bigger. Who exactly is doing the remembering? A crowd is doing the remembering. Markets are crowds, and crowds leave footprints. A price is the sum decision of a great many people at once. And crowds repeat the same emotional cycle every time. Here is the shape it draws. A long, quiet base, a climb, a peak, and then a slide. It starts with accumulation, quiet, and the crowd is bored. Then markup, with optimism building. Then euphoria at the top, where the last buyers pile in. Then distribution, where smart money sells to the crowd. And then a fear-driven decline, as panic and regret take over. Each of those stages ties to a point on the curve. The same cycle plays out on every time frame and every instrument, because human psychology does not change. So you are not really reading lines on a chart. You are reading a crowd's emotions. which is exactly why this one skill travels so far. So why learn to read charts at all? The honest answer is that it buys you three things. Three payoffs of one portable skill. The first is reach. Any market, one skill. Read one chart, and you can read them all, thousands of instruments, and no annual report needed. Stocks, indices, crypto, forex, commodities, all of them. The second payoff is control. Defined risk. The chart shows you where you are wrong, so the maximum loss is set before you enter. An entry here, a stop there, and the distance between them is the risk. The third is that it works both ways, both directions. Chart readers can look to profit in falling markets as readily as rising ones, going long or going short. Long when a rise is expected, short when a fall is. One skill unlocks every market, caps your downside, and pays in either direction. Chart reading is portable and risk-defined. It works in either direction on any market. And that middle payoff, the one about risk, is the one that decides whether you are still here in a year. Here is the one rule that outlives every strategy. Protect the downside, and the upside takes care of itself. Put risk and reward side by side, and the asymmetry is obvious. Start with two lines. Your entry, and below it the stop, the point at which the idea is wrong. Above the entry, the gain runs upward, and it keeps running with no ceiling on it. Below the entry, the loss is a short bar, capped at 1R, 1 unit of risk. Measure the gain in the same units, and you get rungs, 1R, 2R, 3R, and more beyond that. So the upside is open-ended, while the downside is capped and decided in advance. That is the core idea. The loss is fixed in advance and kept small. The gain is left open, and the winner is allowed to run. The edge is that one big win pays for many small losses. You do not need to be right often. You need winners bigger than losers. Traders who keep every loss small and let winners run can be wrong more often than right and still be in the game, which is the whole of Chapter 1. You just finished Chapter 1 of the Foundations module. Underneath every indicator you will ever meet, a market is an auction, a price is an agreement, and the crowd leaves its footprints on the chart. Thank you for watching Trendly Lab. Next up, what is a financial market and how the US market actually works? Where those shares are bought and sold, who runs the venues, and when the doors are open.